All right, welcome back, everybody. This is Arthur Petropoulos here, the managing partner of Hillview Partners, middle market, low middle market, investment banking, M&A, and capital advisory firm, helping companies generating $1 million to $10 million a year in EBITDA, sell their companies, find capital. And we are joined again for part two of our dialogue with Boris Nusinov, Senior Vice President at Rockland Trust, in their corporate and leverage finance group, who we have worked with on looking at several different interesting lending situations, and who's been a close friend of the firm now for a good amount of time. So, Boris, thanks for coming back for part two of the Inquisition here.
I appreciate you having me. This is great. Thank you.
Sure. So I know last week, or last video rather, we chatted on some of kind of the high level, how you got into the business, what you and how your bank kind of looks at situations. How do you evaluate kind of good opportunities? How do you evaluate, opportunities that may not be the best fit? But digging a little bit more, what I wanted to start with today is digging a little bit more into the process of, okay, you find a company that is financeable, let's call it. You have a term sheet. They say, okay, let's go forward into the process of kind of underwriting the opportunity, making sure all expectations line up to get to something that's funded. I guess, what do you deem the most important part of that process of getting kind of from term sheet to funding for a potential borrower corporation to keep in mind?
Yeah, that's a great question. What's interesting is you get a signed term sheet and everybody's pretty happy. You go through your internal credit approval, but then you have to do the documentation piece. What I try to tell companies all the time is I can't control the time lag here necessarily as much as I would like. Because I have a set of attorneys, so will we. And the attorneys will work with the client to make sure that every T is crossed, I is dotted, whatever that is. And sometimes it can get, believe it or not, a little contentious. So what I tell them is we have to stick to what you and I agree to, and the legalese will come into play and we will work it out. The time on that is what can sometimes really hurt, because at the end, there may be, let's say, a covenant that we can't agree on. And I said, well, I didn't get this approved. I'm going to have to get it reapproved. That's okay, but it will add time.
Sure.
Right. And sometimes time irritates people. Right. We're in a society now of instant gratification. And when you say, well, it'll take us 8 weeks to close fund, they're like, oh my God. Could it take 3 or 4? Yes. But then everything's got to fall in line. Right.
Sure.
So what the interesting part, Arthur, if the deal is 2 million or 25 million, it might take just as much time to close.
Sure.
Which I know sounds crazy, but it does. So that's the part. Those are the pain points you have to get around.
Is there anything in a process that you find that clients focus on or really highlight that's less relevant, where you say, hey, look, you don't need to overemphasize that? Because there's sometimes when people are selling a company and they say, I've got my car owned on the balance sheet of the business. How can I sell the business? And we say, hey, don't worry, it's not going to be an issue. Like, it just gets taken care of. Do you find anything in your processes that people, focus on or overly worry about when they shouldn't?
Sometimes it's rare. Usually people are, when we do a straight deal with a corporate client, it's, a lot of credit, term loan, deposits. It's pretty straightforward. The part that you have some discussion is when you're working, and you will understand this very well. You have EBITDA, you have adjusted EBITDA, you have a quality of earnings, and what is really your EBITDA, right? What is really one time, what is not recurring? And I think the most important part there, and I should have mentioned this in our last call, you have to know your customer. I try to know our customer is almost as if I'm working there. I understand those pain points. So you can understand those add backs, but it's hard when you've just met them, right? You look at a bunch of documentation. That's where conversations really matter, right? So you come to a consensus on that. And that consensus, now you have a baseline, now you're moving forward, right?
Sure.
Our consensus, your EBITDA is 5. It's not 5.5, but it's not 4 either. It's 5.
Yeah.
And now we go from that 5, right? What's really happening? That's the part that sometimes you have to either agree to disagree on or compromise, right?
So take it a step further then. Client comes in, they want a loan, they get a loan, they are now a client, and you have capital allocated from the bank to their balance sheet. What does it look like that first year? Do you guys have like a process of kind of tracking things when they're like new clients, new people entering the portfolio of the bank, or how does that first year tend to progress with a new borrower coming in?
So we'll always be reporting requirements. How frequent they are depends. Sometimes they're monthly, there's a borrowing base. Sometimes they're just quarterly. But I think it's almost like a natural connection because you're moving the treasury management over. So you always gonna be like, how's that going? Is that going okay? Is this module working for you? So while you're doing that, you can have other conversations. So you will naturally have those talks. The
Sure.
tougher question is when a 3 or 4 year client, how do you make sure you still treat them as if they're
Yeah.
top of mind? I think we do that really well here, right? But the newer ones, it's a little bit easier to do, believe it or not, because you have to touch them so much more
Sure.
frequently, right? And you say, well, how? And right, and you first come into compliance, and they ask, do you want to see it this way or that way? So you talk more about that, right? And then once it becomes routine, you could potentially, I've seen it at other places, take it for granted. Oh, it's those guys, right? They just do that, right? That's the interesting piece is it's almost like human nature, right? The whole brand new toy, you pay attention to it. Not that a customer is a toy, but you're like, oh, this is new, right? Or if it may be something you're not sure how it works well, you have a new car and you're like, well, how does this work? Versus by year three, everything you get it, right?
Sure.
So that's and I think it's also true for the borrower, right? They're like, okay, Rockland might be new to me, or Boris is new to me, right? How does this work? And then after a while, it becomes a routine for them. And I think we do a good job here providing industry insights. And then the other part I think we can do better in is introduce our borrowers to other borrowers who might have some symmetries in the helping each other do business, right?
And so from the overall process, then kind of going front to back of allocating capital, of bringing on clients, of working with people over time, what is the biggest risk you see of kind of allocating capital as a bank to the C&I space, right? To like the non-real estate, real estate can be a component, but largely the corporate space.
So of course, the lowest hanging fruit is repayment risk, right? You're lending money and you're gauging the cash flow generation of this company. It really, it's interesting, Art, they came to fruition when COVID hit, right?
Yeah.
Before people knew about the payroll protection program, how that would work, who was qualified, people suddenly took a step back. They started asking, well, how well do I know my borrower? And which borrowers will be more affected than others, right? It sort of brought you back to your year one or two in the space. Like,
Yeah, it's
what are the
important.
basics blocking and tackling here? And I think that's the part that you realize that is the risk. I think the biggest risk is you don't know your borrower that well. And a company that relies on longevity and certain, you have a distributor, they'll always be distributing that stuff. Well, can they still distribute it in the pandemic? And the answer was yes. And a lot of times they actually did better, right? Or you have a services company that needs people to walk into their location every day. Now they can't.
Right.
Now that company is really in trouble. Now, of course, that's a really extreme example, but that's what you're always worried about, right? You worry about stuff you don't know. What if
Sure.
not properly insured? What if some tariff hits, right? And you're not anticipating this, and now your repayment risk is really in dire straits. That's the part that can keep you up at night because you didn't know your customer as well as you should have, or your partner as well as you should have, right?
Yeah. All right. So now, in all the years you've been doing this, what's been
Yeah.
is there one single deal that you could say, hey, this was the best or deal experience you ever had, or the most unique situation you ever found yourself in?
Yeah. I won't name borrowers by name. But I will say this: the M&A deals that you do, because those have the highest risk associated with them, when they work out really well, and you see that the enterprise value of the acquirer that you help build grows up substantially, or you see that they've really created something really strong in the market, it's very rewarding, right?
Sure.
It's a highly risk deal. Like you really have to understand how to do it. Not everybody can do them. It's well done, and you sort of learn so much from that. And there's also so much stress involved in that. And so, right, it's almost like the pendulum is so here, and when it goes here, it's like it's great. And then what's interesting is the inverse of that. It's not the deals that have gone a little bit sideways, and you're like, right, we can shore it up. I fortunately never had one that like completely imploded, right? I don't
Sure.
believe, at least nothing significant. But it's the ones you didn't do. Oh, I didn't do that when somebody else did it. And you're like,
Uh,
I knew it'd work out, right? And for some reason, either you couldn't convince your credit team to do it, or your terms weren't as aggressive as your competitor. And you're like, oh, I can't believe they did that. And it works out great, right?
all right. How about the flip side of that? Any worse deal experience or loan experience that comes to mind?
You know what it is, Arthur, honestly, this is the part you can't control as a banker. It's when it's a family owned business and the family starts falling apart.
Yeah, when that implodes.
And now you're sort of like, okay, I have actually a pretty good business here. Family is fighting here. I'm not sure what's going to end up
Yeah.
happening. And you really have to stay out of it, but you're also at risk for it. And I'm an only child, right? So when I have kids, I have two kids. I just can't imagine my kids fighting over money, but it happens and it gets so personal. And I've seen it for years. It's a part you can't control. Like I said, I mentioned earlier, tariffs, but shareholders at odds, or activist shareholders in the public company. Like I remember we had a client who was a public company and they had an activist shareholder, and it just drained the management team so heavily
Yes.
that, right? But it can happen in private companies too, right? You may have ownership of 40-40, and then 20% is this other person who's just hammering the other 40s. Now they can
What you mean.
sort of shove them aside a little bit, right? But they have certain rights, and they start emailing the banker sometimes, and you're like,
Yeah.
whoa, whoa.
You know
Those are
what?
the parts those are the most difficult situations, in my
Sure.
opinion.
All right. Last two questions here.
Yeah.
What would you say? Any regrets over the last 10 years or so?
You know what? My biggest regret, Arthur, honestly, is I didn't network more.
Okay. Interesting.
Like with LinkedIn especially, there's so much more opportunity to go out there and just become more learned. So you can help your borrowers, your future borrowers, whatever that is, just run their business maybe a little bit more efficiently because you learned something. We you know what happens is you're out there, you're doing your business development shtick,
Sure.
then something hits and you're like, okay, and then you get bogged down for a few months. Remember, I said documentation takes a while and you're out of the market, you're not networking. And I
Yeah.
think that opportunity cost. I wish 10 years ago I was more organized and really hammered it hard.
All right. So in light of the wisdom that only comes with some of the hard knocks in these businesses, what do the next 10 years look like for you, for Rockland, or how do you kind of see the future evolving?
Yeah. So it's going to be a year for me on the 27th. I mentioned that last time, I believe.
Yeah,
I hope to honestly uh, see Rockland Trust become the true alternative to the big banks for C&I lending, right?
sure.
Bank of America, Wells, Chase, right? They're the big PNC, they're the big banks. They're great at what they do. But if somebody wants a regional bank, right, a little bit of an alternative, right, like us to be it. And I think for that to happen, customer service has to be first and foremost, answering your phone, email, text, whatever that is, first and foremost. And we have to provide sound strategies, sound structures, and be true partners. And that is the goal for the team. And I'm hopeful we can achieve that goal. We'll see how it goes, right? Go year by year.
Very well said, Boris. Well, look, I really appreciate all the insights here between this conversation and the last one we had. A lot of things for people to think on and digest. And we get the question so many times and that's why we've done videos in the past. It's like, what does private equity actually look for? What are buyers actually looking for?
Yeah.
What do they think? And the question comes up just the same as what are lenders looking for? How do they perceive kind of the universe, if you will, and how does all of this kind of interconnect? So this is going to shed a lot of light and I think help a lot of people out, our clients and just everyone in our network. So very
Well,
much
I hope
appreciate
so.
the
I
time.
hope so. I appreciate your time. And I think it's interesting how our ecosystem sort of works with one another, right?
Yes.
Um, and I think it would be great to continue to do this. So thank you.
Sure thing, Boris. All right, this is good. We'll do it again soon. Until next year.
All right, till next year.
All
Take
right,
care.
be
Thanks,
well, my
Arthur.
friend.